Now, let's go on and talk about each of them in more detail. I just tried to give a broad level idea, but now let's go ahead and talk about it in detail. 179 election, as I said, it is optional, not mandatory, applicable on purchase of both old and new, whether bought or financed. So, had it been, I had not paid the 100% money, but I got it financed, still I can claim the 179 expense and claim the expense deduction of depreciation. So when I say expense deduction, I think it may make it confusing. So understand it. I am able to claim my expense and I'm addressing that expense as a deduction to the taxable income. Just keeping it short. All right. So it the list of assets are like these are all, but not exhaustive, but mostly all like business equipment, machinery, office furniture, tools, vehicles, computers, off the shelf computer softwares used in the business. So these are some acquisitions which are used in the business. That's one thing. It should be other than real property. That's right. It is not applicable on real property or any property purchased from related parties. Maybe IRS have identified that the SSC may purchase from related party and claim a full depreciation on it. So that's why they have excluded. But when we say real property, it includes the real estate. It also includes expansions made to the real estate or in improvements like installing elevators and escalators. So all these are also excluded. Let's talk about the hot part of the topic. It says that the deduction is 100%. So you can claim a deduction of 100%. Let's take an example. I bought a business equipment worth $500,000. I am eligible to create a deduction to my taxable income, which is up to the 100% limit. First year of acquisition and put to use, I will be able to claim a full expense of $500,000 on my taxable profits. So I claimed 100% depreciation in the first year itself. I didn't have to wait for the useful life of the asset. But I can see it's written that there is a limited deduction up to 1.08 million or $1,080,000. It means that if I am making a purchase, I am eligible to claim 100% of the purchase value, but up to the extent of 1.08. In our example, we were $500,000, very well within the limit, but it is fine for the first year, right? It says that there is a phase out of 2.7 million. Let's make our example more interesting. It says that had it been suppose you bought an asset worth 2.7 million, you can claim 100% deduction up to the extent of 1.08 million. But what if I bought an asset worth 3 million? So I bought an asset of 3 million, which is on top of the phase out limit of 2.7. So $300,000 is on top of it. It means my 1.08 million deduction will get reduced to the tune of $300,000. And the last interesting fact is that 179 expense can be claimed to the extent of profits. So if I have taxable profits and I claim my 179 expense and still remain in profits, well and good. If I have taxable profits, claim the deduction and be on zero profitability, still good. But I cannot be on a negative profitability. I hope that makes sense. For more content like this, please follow Learning Lane with Paras.